Joining us, Arun Sundaram, equity research analyst at CFRA, covering the consumer stocks, and Alex Coffey here in studio hosting Next Gen. We're going to look at some of the options here. So, Arun, when we kind of look at Prime Day, firstly, is it a mover for Amazon as a stock?
It really isn't, Oliver. Prime Day, although it's a big savings event, but for Amazon, it's really, about 1 to 2% of their total annual sales for the entire year. So it's not a big mover for the stock, but, it does kind of give us a signal of where consumer spending will head, especially given, the upcoming key holiday seasons, like back to school and obviously the Black Friday and things like that. So it's a good indicator of where consumer spending will head.
Yeah, that's where I think the main kind of thrust of the importance from this is kind of a check-in on what we've heard about with people pricing down and trying to penny pinch a little bit. But I guess if it's an environment where Costco can up their membership, then Amazon should be doing pretty decent for their Prime members, right?
Yeah, no, I think Costco and Amazon are kind of in a similar boat compared to other retailers, and I say that because both Costco and Amazon, they kind of tailored to that middle income or upper income consumer who's doing much better right now in this environment than that lower income consumer who seems to be struggling a bit more. And also right now, it's the retailers that are doing really well. They're the ones that have membership models. Obviously, Costco has one, and Amazon has a really strong one. The retailers that are kind of struggling are the ones that don't necessarily have a very strong membership model. For example, Target. Even though Target just this year they introduced their own membership model called Target Circle 360, but it's still very early stages in that business.
Okay. The overall retail business as a force for the stock, do you feel that it plays maybe a bigger role? Because I look at all these cloud companies, and a lot of these cloud companies are doing real poorly over the last 5 months compared to tech generally. And I kind of wonder if maybe, the Amazon chart kind of looks more like a Walmart or Costco. I mean, it looks like a tech chart too, but I'm just kind of like saying compared to cloud, compared to retail, it kind of looks more like a few of the big retailers like Walmart and Costco. Is it unreasonable, Arun, to think maybe the retail part of it's playing a bigger role as a catalyst these days?
I think so. I mean, the retail business is really doing well. It's growing, faster than peers, meaning Amazon's gaining market share. I think one of the reasons a lot of these big retailers or stocks are, sitting near all-time highs is not even because of its retail business. It's actually because of its advertising businesses. So like Walmart, for example, is really kind of kicking the next gear in advertising. Amazon's the largest digital retail advertiser in the space. And that advertising business for Amazon is growing at about a 25% clip year over year. And this is where the margins really lie. And I think investors are really excited about the advertising businesses of all these major retailers. And then obviously with Amazon, it also has AWS. And we saw last quarter in Q1 some pretty significant reacceleration in that AWS business. It grew 17% in Q1, up from 14% in Q4 of last year. And there's the expectation that AWS business will continue to reaccelerate this year, driven by the continued migration to the cloud and obviously the whole all the opportunities in generative AI.
The price target you guys got on at $233, 4 out of 5 stars. I mean, it's hard to ask for more, but what's that extra star that's missing, Arun?
No, I think for this year we'll likely do see some risks in that retail business. Consumer spending is likely going to slow a bit this year. I don't think we'll see as strong of a growth in that e-commerce business as we saw last year. I also think investors have kind of come to realize that Amazon's really kicked the next gear in terms of profitability. We saw some really significant operating profit growth last year. We'll likely continue to see that this year, but expectations have come up a bit since last year, and I think that's what's keeping us away from a strong buy rating. But we still do have a 4 stars buy rating and a $233 target price.
Okay, understood. Plenty of room to go from here then. Thanks, Arun.
Thanks.